Alrighty. So in today's video, we're going to be talking about how I trade the short strangle. So I'm going to get into the entry, the exit, as well as how I manage those trades. Now, before I get into them, the first thing that I want to share with you is the performance of the last 100 trades that I did for the strangle. Right, so whenever you're putting on any strategy, it's important to at least get a sample size of 100 trades or more. Then this way you'll be able to get a much better picture of how the strategy is doing. Right, so many people make the mistake of just putting on 5 trades or maybe even just 10 trades and then think that that's going to decide how the strategy is going to play out in the future. The most important thing is that you do need a large sample size, right? The more sample size that you have, the more the true probability of the strategy is going to play out over the long term. Okay, so let's take a look at some statistics down here. So it's the last 100 trades that I did. So as you can see over here, the win rate is 79%, which is somewhat in line with the strangle strategy based on certain mechanics, which I'm going to share with you later on. And then the loss rate basically is 21%. And then the average win, as you can see, is about $207. And the average loss is $221, which is slightly bigger than the average win, which is normal, right? Generally, your average loss for the strangle would always be bigger than your average win. And if you're someone that is interested in expectancy, then the expectancy is about $117.12, right? So basically the expectancy is, when you calculate it, it kind of tells you whether the strategy is, profitable or not profitable based on the 100 trades, right? And this is what we kind of expect as it moves forward. So again, it's very important to put on at least 100 trades. So for any strategy that you want to put on, the law of large numbers apply, right? The more trades that you have, the more the probability will pretty much show in the long term. So for example, if you were to just flip a coin, an unbiased coin has a 50% chance of getting heads or tail, right? But if you were only to flip it 5 times, and if you're very lucky, then it's very possible that, you could flip heads 5 times, right? Then you might be inclined to think that, hey, this coin is unbiased, right? But is that really true? Now, that's not true, because if you were to flip that coin for about 100 times, 1,000 times, 10,000 times, then you will see that the probability of getting hits slowly start to go to the actual mean of the probability, which is about 50%. So the same thing applies for this strategy down here. So one thing very interesting for you to note down here is that if you were just to take a look at the last 1/3 of the trades that I've done, this last 1/3 is actually a negative. Right, that means you are actually in a loss after you place about 34 trades. And many people, right, especially if you come in during this time and you put on the strangle and you have 34 trades or so, and imagine that these 34 trades have spanned across maybe a couple of months, right, maybe 2-3 months or so. And then at this point, you might be very demoralized, thinking that this strategy doesn't work, and you might just want to discard it. But if you had discarded it, then you would have missed, the other trades that would, in the end, play out the probability, right? So as you can see down here, the first 2/3 of the trades were actually pretty good, right? They were all profitable. In fact, the probability was a little bit way too high for the strategy, right? You notice that among about 66 trades, there's only like 1, 2, 3, 4, 5, 6, 7, 8 losses. So 8 losses out of 66, that is a very, very high win rate. But the strategy by itself does not actually have a very, very high win rate, right? The mean should be around 70-odd%. So if you start to trade it more slowly, the probability will start to show by itself. So again, this whole sample size down here is to show you the importance of at least putting on 100 trades or more in order for you to know the true performance of this strategy. All right, so this is the performance of the last 100 trades. So how did I actually enter, exit, as well as manage my strangles to get this kind of performance? So I'm going to get into it right now. So first off, if you're new to trading the strangle is basically an undefined risk strategy that consists of 2 naked positions, right? You have your short put as well as your short call. So both of them are out of the money. Now, when I'm trading the strangle, there are basically 3 different strangle types that I trade, right? When I enter into the market, it depends on, the underlying market condition and my view of the underlying market, right? So these 3 strangle types, the first one is the neutral strangle. So the neutral strangle for both the short put as well, the short call is around 16 to 20 deltas. So basically when you're trading this, you're trading what's called the expected move. So as you can see down here, this is a study done by the Tasty Trade team whereby they tested all the different delta for the Strangle. So as you can see down here, the one that I usually trade is somewhere around 16 to 20 delta. And as you can see, right, this strategy by itself, even though if you go somewhere around 40 deltas, which is a pretty high delta, that means your short put and short call is much closer to where the current market price is. So let's say, for example, this is the current market price around 179, then your 40 deltas might be somewhere around here, right? So this will be your short put, this will be your short call. So you actually have a pretty narrow profit zone. But if you notice, in the long term, it's actually still profitable, right? So this sample size, or rather this test which the Tasty Trade team have done, is over quite a number of years. So in terms of statistics, is rather significant. So as you can see down here, the net P&L per trade is all a positive, right? So that's why, again, it's very important to put it over the long term rather than just put over 2-3 trades or so. Because if I were to just go back to the table down here, you can see that I've actually suffered, about 4 to 5 losses in a row, right? Let's just imagine that I didn't take this trade for some reason, right? And then I just went on with these 5 trades. You will see that these are 5 losses in a row, and the losses are pretty big, right? You have a loss of total maybe up to $2,000 over dollars. So at this point in time, you might be very demoralized thinking that this strategy is not working. But again, it's very important to just keep on putting the trades over and over again until the probability plays out. So the one that I put for the neutral Strangle is generally around 16 to 20 deltas. So you can see that for them, they exit at 21 DTE. So for them, it's very mechanical how they exit. So they just put on the Strangle, and whenever it's 21 DTE, they close that, and then they put it on again. And based on the 16 to 20 delta, the Strangle, they have a win rate about 74 to 75%, which is not too far off from the win rate which I got, right? So my win rate is about 79%, is slightly higher. And one of the main reasons is because on my trades, I also tend to take profit slightly earlier than the 21 DTE, depending on the situation, which I'm going to share with you again, right? But basically, you can see the probability is somewhere around there. So this is for the neutral Strangle. Now, the other Strangle that I put on is what I call the bullish Strangle. That means that if I think that the market might be going up, then I might choose to go for a more bullish Strangle whereby I'm pretty much just shifting the whole Strangle structure upwards, right? So as you can see down here, this is the neutral. So let me just remove the drawing. So what I'm going to do with the bullish Strangle is that I pretty much just shift this to upwards, right? So as you can see down here, this is the bullish Strangle. Now, the bullish Strangle for the short put, I'll be slightly more aggressive with the delta. So it's more than 20 delta. So sometimes I go for 20 to 25 to 30, 35, depending on, how bullish I am in the market. And then for the short call, I tend to put it slightly further away, right? So it's about 5 to 15 delta. Now, the last Strangle that I put on would be the bearish Strangle. So if I think that the market is going to go down based on, the market's movement, if I think like, for example, if it's over exhausted to the upside, the market has gone up quite a lot, then I might just choose to put on a bearish Strangle. So in which case, now the short call will be more than 20 deltas and the short put will be somewhere 5 to 15 delta. So basically, I'm now shifting the structure downwards. So these are the 3 different types of Strangle that you can also put on. Now next, let's get into the exit rules. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So I have a few rules when I trade the short Strangle, and these rules are going to be pretty strict, mainly also because this is an undefined risk strategy. So with an undefined risk strategy, if you don't manage it properly, then it's very easy for you to get, huge losses that you may not even recover from. So as much as possible, I always want to manage my risk very well. So the very first rule is that my latest exit would be around 21 DTE in terms of time, right? So as you can see down here, this study over here is done by the Tasty Trade team as well, where they compared 2 management style, right? The first is you exit at 21 DTE, which they call it managing earlier. And the other one is if you exit at expiration. So in both cases, they're both profitable. It's just that when you exit at 21 DTE, your performance is better, right? Because you also tend to limit your losses. So there are times whereby the market can go all the way in one direction, and if you hold all the way to expiration, then that's a time where you could suffer a pretty big loss, especially as you can see down here during market crashes. This was during 2008, 2009, during the subprime crisis. So this is time where the market really crashed. And as you can see, if you held all the way to expiration, your drawdown would be bigger than if you were to exit at 21 DTE. So for myself, this is a rule that I always hold on to. Now, the next rule is that I also choose to take profit at 50%. Right? So for my rule will be either 50% or 21 DTE for some of my trades, right? Some of my trades I will do this, and some of my trades I will just leave it to 21 DTE. So whenever I'm trading the Strangle, I tend to have a few positions on at the same time. And as you can see down here, this is the study done by the Tasty Trade team on the different management style as well. So previous table, I showed you just only the 21 DTE as well as the expiration. Now for this, they have two other a management style. So the first one is the combo. So the combo is basically 50% take profit or 21 DTE, whichever comes first. Now the winner is basically 50% take profit or expiration. And then the one that is earlier is basically managing at 21 DTE. That means you exit at 21 DTE. And finally, the last one is to exit at expiration. So as you can see, as long as you do not exit your trade at expiration, right, you tend to have a better results if you choose one of the other ones. Now, the third exit rule is that if there are multiple positions with the same DTE, then I'll generally stagger my exits, right? So here's what I mean. So let's say, for example, I have 3 Strangles on and all of them have the same DTE, which is currently at around 23 DTE. So at this point, what I'll choose to do is that I might just close out one of them first, right? I'll close out one of them first at 23 DTE left, and then just leave the remaining 2. Then the next day comes, and then both of them becomes 22 DTE. At this point, I'll close out one more, and then finally on the last Strangle position, which I have, which is at 21 DTE, this is when I'll close out the final trade. So when I do it this way, I pretty much am smoothing my P&L as well as I'm diversifying my trade as well, because I might not know what's going to happen the next day, right? For example, what if the market suddenly crashes the next day? If the market crashes the next day, then I have all 3 positions all of a sudden taking a very big hit. So if I had actually exited some of the positions first, then I'm going to take hit on, only a couple or just one position, which is not that bad, right? So all I'm doing down here is, as much as possible, I'm trying to diversify my exits as well as smoothen my P&L. Now, the very last exit rule that I have is if the loss exceeds the initial buying power requirement for putting on the trade, then I close the trade. So again, this is because this is an undefined risk strategy. So if you were to take a look down here, it says your max loss is negative infinity. Basically, what it means is that if the underlying goes to 0, you could lose a lot more than what you have in your trading account. So that is why it's very important to manage your max risk for any undefined risk trade. So for the Strangle, as long as it hits the buying power effect that I put on for the trade. So for example, as you can see down here, this buying power effect or buying power requirement, both are pretty much the same term. So as long as it hits this amount that I used to put on for the trade in the first place, that means I use this capital to open up this trade, I'm going to exit it, right? So this is a non-negotiable rule. This is as much as possible not to let any single trade wipe out my account. Okay, so especially when the market crashes, this is the time where you really need to be on your toes to see, hey, has your loss already reached the initial buying power requirement? If it has, then it's time to just close the trade. So these are the 4 exit rules that I have. Now, finally, let's get into trade management. So trade management basically just involves rolling, right? So I only decide whether to roll if either of my short strikes are tested. Right, I do not roll if my short strikes are not tested. As much as possible, I don't really want to roll and just keep this max profit zone down here the same width. It's only when I get tested on either side, then I choose to roll or not. Now, if I do roll, I only roll the untested side. So this is very important to understand. So for example, if I'm tested on the put side, then I will generally want to roll down my call option. Okay, and if I'm tested on the call side, then I'll be rolling up my put option. So I do not roll the tested side. So some people have asked before, saying, hey, Davis, if I've got tested on the call side, can I just roll this further away? So this way, what happens is that your profit zone now becomes wider because you had your original short put. Let's say your original short put was here. Then you have a much wider profit zone compared to the previous one when you first put it on. And the answer is that I don't really do this is because when you roll this short call up, what happens is that you're actually going to pay a debit, right? If you pay a debit, that means you're increasing the risk and reducing your credit on your trade. So that is why I do not roll the tested side. I only roll the untested side. Next, if I have multiple positions, I will only roll some and leave the rest to diversify and smoothen my P&L as well. So let's say, for example, if I have, say, two positions, two strangles that has been tested on the call side, then what I could do is that one of them, I will actually roll the put, and on the other one, I'm not going to roll it. I'm just going to leave it. And the reason is because I want to prepare for the possibility that in case the market comes back down, I don't want it to come down and test both my strangles, right? Because if I had not actually rolled them, then I would have been in a very good profit zone, right? So let's say, for example, the original one is this, right? So right now I can have two strangles, one I rolled and one I left it. So if the market actually comes down, then this one that I rolled down here is most likely going to be now back into a loss, right? Because it came down too far and it tested the put strike that I rolled to. But I have another one which I didn't roll. So this one will now nicely be in a profit. So in this case, I'm diversifying my P&L as well. Alright, so this is how I trade the short strangle, and if you found this video helpful, I greatly appreciate it if you give me a thumbs up on this video. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.